Alchemy Capital Management is here with us on the show. Alok, thank you very much for joining in. This is Reema here. Globally, there is a lot more optimism today because the sense is that perhaps we're closer to the end when it comes to the entire tariff episode. But back home, the Indian markets have been in a bit of a range, in a bit of a funk. What's your overall view of the global markets, the Indian markets, and where we're headed and where we are right now?
Yeah, hi, Reema. Thanks for having me here. Completely taken that point that the global markets are actually doing much better in the short term. But if we really look at our own markets, after that sharp correction in the months of Jan and Feb, from early March till now, we are up about 20% at the broader index level, Nifty 500. So 4 straight months of decent gains and followed by a consolidation month like July. Actually, it's very difficult to complain out there. And it's all this happening amidst the fact that the macro numbers on growth and liquidity and interest rates and inflation all were improving. So many events like the tariff announcements to the war-like situations between India, Pakistan, and then actual wars like Iran, Israel, all these were happening. Corporate numbers were improving. So after 4 strong months, a consolidation month is quite welcome.
But are we likely to continue to consolidate? Are you sensing a breakout? What's been the read from the earnings season?
So we are quite constructive on the markets. For us, this is just a pause amidst a larger rally. So we remain positive on the markets. The fact remains that despite 2 quarters of slowdown in the previous financial year, corporate earnings still stands at a 17-year high compared to as a percentage of GDP. So the numbers are rising. That was a shallow period wherein the GST collections and some macro numbers started decelerating, but the things seem to be back on track. The negative liquidity in the system early in this calendar year has also been addressed. The various proactive steps taken by the RBI are also yielding fruits now. It's too early in the earnings season so far, but whatever numbers, like around 16% of the companies have reported numbers. And when we see those numbers, they are decent double-digit numbers so far. And it looks like the earnings season is likely to go ahead with that double-digit earnings growth to come up, with slight improvements seen in select sectors. And going forward in the year as well, we remain positive.
Okay. Alok, hi, great to have you on this afternoon. So tell us, when the market continues to be in a range and we know that valuations aren't easy or cheap anywhere. So what is your portfolio looking like right now? And what is getting top billing and what are you avoiding?
Hi, Surabhi. The interesting part that we're noticing, especially in the recent quarters, has been that some of the index heavyweight sectors, they are the ones that are not really showing too much of growth, both in the near-term reported numbers as well as the near-term estimates. And the broader sectors which are really showing growth and the visibility and certainty of it, they are not adequately represented in the indices. What I'm referring to is that the heavyweight sectors like oil and gas, FMCG, banking, and IT, they are the ones that are kind of struggling on the growth front, being slightly below the overall corporate earnings growth, almost slightly below the nominal GDP growth as well. But broader area sectors, things like financial markets, capital market services, the real estate, the aviation, the hotels, the hospitals, some of the manufacturing and industrial areas like defense, power plays. So a lot of these areas which are not adequately represented in the key indices, they are the ones that are showing a lot of strength, including the recent ones which are showing turnarounds like chemicals and cement. So these sectors are the ones that are actually dominating the portfolio and also having a larger share in the overall earnings growth that is coming in the markets.
So chemicals, cement and power, right? These would be your top 3?
I would say top 3 out there would be the capital market plays, the industrials led by defense and power, and the real estate as well.